right, everyone, welcome to the R&D tax credit. I am very pleased to be hosting this with Tyler Kem from R&D tax credit, or I'm sorry, it's Strike Tax Credit. Why do I screw this up every time, Tyler? What's the name again? Tell me one more time.
Strike Advisory, Strike Tax. Yep.
All right, Strike. That's the name. Anyhow, so Tyler is going to walk us through how this process works with the R&D tax credit. I will just say on the top of this, there is so much money that is left on the table that companies are not aware of that they are eligible to take. Tyler's firm, the reason why I partnered with them is the way that they work with potential clients and how they're able to save a tremendous amount of money, and tell you this up front prior to there being any costs or anything associated for clients. So Tyler, with that, I'll go ahead and turn this over to you.
Thanks, Francesca. Cole, Kimberly, Ken, thanks for joining. Really want to be able to use this time to answer any questions that you guys have, but definitely take a deep dive into the R&D tax credit and, how we operate at Strike. For those of you that are not familiar, we are a research and development tax credit consulting firm. So we're not the day-to-day accountants. We're not the tax preparers. We don't claim to be the client's CPA, rather an extension of the business owners itself and the CPA firm, looking to maximize the tax credits themselves, calculate, document, substantiate, provide full audit support. And, so you can think of us as kind of your full service tax credit consulting firm that is really looking to maximize your tax credits. And we do this under a success-based fee structure, which, a lot of the folks in the R&D tax credit industry typically charge on credits identified, and that could come with a retainer up front, monthly billings, fixed fees. We've somewhat eliminated the barrier to entry by not requiring a retainer, monthly billings, fixed fees, but rather tying our success to our client's success. So that's what we call a success-based fee structure. And again, we get paid when the tax credits ultimately get utilized or when they're refunded. And like Francesca mentioned, there's just so many industries out there that do qualify for these R&D tax credits that most CPAs are overlooking. And part of our job is just to educate on the different types of industries that can qualify, the different types of companies that can qualify, and certainly what activities and expenses qualify. So that's what we're going to be going through here today. And, want to be able to answer any questions that you guys have up front.
So Tyler, I just have one question for you. Some of the R&D tax credit companies that are out there will only go backward looking. So do you help going forward looking as well?
Yeah, so with the R&D tax credit, you are allowed to go back the last 3 years, really as far as the statute of limitations are open. So at the federal level, you can go back 3 years from the filing date, which we absolutely help our clients go back and maximize the tax credits. By going back and amending prior year tax returns, that's where cash refunds can be issued for either the corporations or the partners themselves. Just as the profit and losses flow through to the partners, so do the tax credits. So in a lot of cases, this is a business tax credit. However, the partners and shareholders do benefit greatly, from this tax credit at the flow through level. In addition to being able to go back, we absolutely look to establish best practices and protocols to really help the business owner and the accountants understand what are qualified activities, what are qualified expenses. And this, at the end of the day, this is a tax planning tool that the business owners and the CPAs can use to take more cash home at the end of the day. So a big part of what we do is not only going back, but helping them establish best practices and protocols going forward, so that they can better easily identify what these are. And, it's, again, like I mentioned, a tax planning tool at the end of the day that's meant to go forward. See, we have a few other folks that have joined us. Thank you, guys. Thank you, Casey. We were going to make this a little bit of an interactive type of webinar where we can go through the site, the striketax.com website. We have a bunch of information on the industries, the different states, the payroll tax credit opportunity. We've got a tax credit calculator that we can play with a little bit just to see how these tax credits do fall out. I guess before we get started, is there any questions that I can answer here now? All righty. Let's see here. Can you guys see my screen?
Sure can.
Beautiful. So we are Strike Tax. Like I had mentioned, we are a R&D tax credit consulting firm that's made up of CPAs, enrolled agents, attorneys, technologists. We've got biochemists on the team as well as PhDs. So we do have a diverse background of folks in the R&D tax credit industry with a number of years of R&D tax credit experience. And you'll see here that, again, this is a tax credit that is permanent on the federal level. It was made a permanent federal tax credit in 2015, and there's 36 states that have their own version of the state tax credits. So again, we'll get into what states qualify and how to maximize these credits. Really, the R&D tax credit again is a tax credit that's been around since 1981. It's a tax credit that has come and gone quite a bit. However, the government sets aside close to $50 billion a year for these businesses to claim the tax credits. Roughly 18 billion of those gets claimed every year. So there's an additional $30 billion that goes unclaimed. And we see this as a tax credit that your CPA and the business owners have to be proactive about claiming, otherwise they will go unclaimed. And the incentive behind the tax credit really is from the government to incentivize businesses to keep these technical jobs here in the US, as opposed to outsourcing for cheaper labor overseas. You pay higher wages, you pay higher contractors, and you get a tax credit back. The government wants to give you these tax credits. They want to incentivize the innovators and the entrepreneurs to get money back, and this is their way of doing so. So again, on average, we can see, roughly 15% of your qualified expenses coming back in at least a federal and state tax credit. And so again, we work with your accountant to streamline the entire R&D tax credit process. And, we'll help in identifying the potential tax credits, the expenses, and making sure that your accountant can claim these on your federal and state tax returns. We'll make sure that the process is seamless and providing the forms, line by line item that they would need to input onto the tax return to claim these credits. These are tax credits that do need to be claimed on the tax returns themselves. And in doing so, we're going to provide, not only the calculations, the tax forms, but we do provide documentation, when it comes to, we call it an audit ready deliverable, where we will document our results, how we did it, why we did it, with all the supporting schedules. So the business owner and the CPA feel, 100% comfortable with why we calculated the credits the way we did, knowing that we do have to support those and defend those in the event of an audit. So you'll see here that we also provide unlimited audit support in terms of hours to substantiate our claims. So again, no out of pocket costs up front. We get paid on a truly success-based fee structure. We offer unlimited audit support, and we go as far as claiming that we have a fee guarantee. So if the credits ever do get clawed back by the IRS, say maybe 15% gets clawed back because we were overly aggressive, 15% of our fees go back to our clients. That has not happened yet. We haven't had to give anything back. We've substantiated 100% of our tax credit claims, and we anticipate on doing so going forward. As you'll see here, there's a number of different industries that can qualify, in addition to the number of states that also have a state tax credit. At any time, you can come to our site at Strike Tax and book a time on our calendar, free preliminary analysis, discovery call, and you'll be able to connect directly with one of our R&D tax credit specialists. Next, we have a R&D tax credit calculator that is rather accurate, and it's meant to just be an estimate. So this calculator by no means is the final numbers. However, we do want to make sure that you guys are getting the experience and understand how the tax credits are calculated, which we'll go through here in a bit. Next, you'll see a number of journal entries and articles here and testimonies on the bottom. So first and foremost, I do just kind of want to jump in here to the calculator, and we could certainly take a deep dive into the industries thereafter. But I think this is a powerful calculator for everybody to see, how these tax credits can be calculated and how they do start to fall out. Does anybody have any specific use cases that they would like to for us to look at?
Tyler, do you want to go through the four components of what makes you eligible and then the industries before we jump to?
Yeah, no, that's a great point. So let me go ahead up here. You'll see that at the top, we do have the what is the R&D tax credit. That is a good point. So again, we do have the federal and state tax credits, and what's super important to remember, when going through, what activities qualify, what expenses qualify, is this four-part test. And for any of the activities or expenses to qualify, all four parts of this test must be met. And the first part is permitted purpose. So the intended activity is to develop or improve a product, process, software, technology, invention, patent, or formula. Pretty broad in nature, which takes me to the next part, which is technological in nature. Really, the activities must fundamentally rely on the hard sciences, such as computer science, engineering, biology, physics, or chemistry. If that is the case, we can continue looking at parts 3 and 4, which are a process of experimentation. And in part 4 is elimination of uncertainty. So at the outset of the project or the process or the technology, did you know exactly how to do it? Or did you try processes of experimentation along the way? And that could have been systematic trial and error, evaluating alternative methods, procedures, components, or materials. Ideally, you set out to develop or improve something. You weren't able to get it right on the first try. There were processes of experimentation as it related to resolving the technical uncertainty. And at the end of the day, success is not a prerequisite. So I think, if you can prove that you weren't able to do something, you're certainly performing R&D activities, and the expenses associated should be qualified. Is there any questions about the four-part test or what activities may qualify?
Tyler, I don't have a question specific to that, but you've used words like streamlined and seamless, right? And you're working with the government, so we can certainly understand that it might be cumbersome, but it might be helpful to me to understand the difficulties that you add value that an accountant wouldn't add value because of what they're facing in terms of obstacles or encumbrances that allow for a service like yours to provide streamlining and seamless help.
Yep, no, it's a great question. So we have partnered up with our CEO is a technologist and serial tech entrepreneur. So we are building software to streamline our service. We're going to be able to integrate with over 25 different payroll providers and 25 accounting systems. So the biggest pain point in this process is gathering the financial documents needed to start the tax credit calculations, which includes a number of tax returns, general ledgers, payroll reports, 1099 reports. So we're building technology to streamline that from end to end. So that's one piece that we are assisting with and streamlining. When it comes to the actual process itself, it's very much a forensic accounting, legal analysis, but also a very technical analysis, right? So that's why we do have technologists and engineers and PhDs on staff to really understand the nature of the business that is performing the activities. Traditionally, CPAs perform these studies, and CPAs are accountants by nature, but they might not have the technical expertise that a biochemist would have when it comes to understanding what a chemical manufacturing company really does. So we're able to speak the languages of the businesses that are performing the work, which informs us really how to document and understand what activities are qualified. And CPAs, they're very much generalists when it comes to doing the day-to-day accounting, doing the tax return work or the audit work and advisory work. Whereas these studies can take anywhere from 40, 50, 100, 200, 300 hours sometimes. And CPAs a lot of times just don't have the time and resources to really understand Section 41 of the IRC tax code. There's really how we calculate it is Section 41 of the tax code, but there's a number of Treasury regulations and court cases that inform us how to document and substantiate these tax credits. And so unless you've gone through an audit yourself, and really understand what the auditors are looking for, the 21 questions that they're going to ask, it's going to be rather tough to know how to calculate and document these tax credits. And so that's the expertise that you get here at Strike is, not only are we looking at the forensic accounting, doing the legal analysis, reviewing the tax returns to determine rights and risks. We're also going to be providing that unlimited audit support and giving you that insurance policy that, we're going to stand behind our numbers and, make sure that the CPAs can do what they do best.
Really good answer. Thank you. I have a relationship with 274 of the 470 PEOs in the United States. When you talked about working with payroll companies, Francesca can offer you my contact information, but maybe I could be useful to you.
Oh, absolutely. No, I appreciate you, sitting here in this meeting or this webinar and, asking that question. PEOs, are definitely that point of, I guess that center of influence that, we often see a lot of the companies going back to their payroll providers and asking these questions. And a lot of the payroll providers just don't have those answers either. We've worked with a number of PEOs that didn't even know that the R&D tax credit was available or that you could take the payroll tax credit offset. And so, we still see ourselves educating a lot of the PEOs that this is a tax credit that their clients should be taking.
Yeah, they don't know what they don't know, right?
Right. Exactly. So we do see this as very much educational. We set out to educate quite a bit, the CPAs as well. We still see that roughly only about 50% of the CPAs that we speak with have ever even heard of this tax credit. And, we do put a big emphasis on trying to just educate. We do partner with a number of CPAs and outsource CFOs and law firms to streamline the credit. Thank you for that question. The next part is what expenses qualify, and so there's really 3 to 4 categories of expenses that we're looking at to generate these tax credits, and it is a labor-based incentive. So we are looking at those employees and contractors. So again, employees, W-2 box 1 amounts to those doing the direct research. However, it could be someone supervising the work or supporting the work. So we'll look at all levels of activities and to make sure that we're maximizing the credit. Additionally, contractors, subcontractors, vendors, or 1099s here in the U.S. that are doing the research on behalf of the taxpayer can qualify, as well as supplies and materials being used and consumed during prototyping or testing phases. Some industries qualify for those supplies and materials more than others, such as manufacturing. And then computer rental and cloud computing costs can qualify as well. So we see this often in the software and technology space. Folks that are using Amazon Web Services, to host their development platforms can qualify as well. So again, we're looking at the wages, contractors, supplies, materials, and cloud computing costs, whereas we're not looking at sales, general, administrative, meals and entertainment, travel, etc. And then this is just some of the documentation that we look to accumulate just to get started. And it is, again, the tax returns, the payroll reports, the general ledger, and then certainly the project list and any supporting documentation that we can collect along the way. All righty. So next I am going to jump into this R&D tax credit calculator where we can all kind of see, how these tax credits fall out. Was there a certain industry that we did want to talk about maybe first, or a state?
I always like the beer and wine.
Okay. Sure. So, we can start kind of just by, we can use a brewery as an example. Really, this tax credit calculator is meant for you to enter your gross expenses. So again, total payroll, total contractors, total supplies and materials for each year. Again, you can go back as far as 3 years. So, currently we're helping businesses go back and amend their 2017 tax returns. So I'm just going to input, breweries, they do have a lot of supplies and materials that are being used and consumed. So I'm going to go ahead and just call it $1 million. About $1 million in payroll, contractors, supplies, materials. We can start scaling it back here. Maybe in 2017, they were just getting started. So, and then is there a state? I'm in California, so I will just kind of pick California. California does have an R&D tax credit. You can see here that you can also pick the different industries. All of these industries have industry averages as to how qualified those expenses are. And those are kind of built in here to this calculator. You'll see down here, we have the winery and brewery space. So you can go ahead and calculate your reward. Again, this is just an estimate, but it is a visual just to give you an idea of what tax credits you could be anticipating. And again, on that $1 million of gross payroll, contractor, supplies, materials, you could be looking at around 35,000, in federal and state R&D tax credits. You can use the same numbers, on a different industry, and you'll see, how the tax credits do fall out a bit differently. Again, all of, when engaging with Strike, you do get the no out-of-pocket expenses, that unlimited audit support, that money back guarantee. And if you're looking to just get more information about this estimate, you could always just drop your email in here. Get started, and we will send you a detailed report, just taking a little bit deeper dive into what that estimate means. And look to set up a discovery call with you to learn more about the business.
So Tyler, can you speak a little bit to the states? Because there were so many different states, and then how does the calculator work with those states?
Yeah, exactly. So we do have a state map. I guess you could call it more of an interactive state map where you can learn about all the different states that do have an R&D tax credit. You'll see here in orange, anything in orange does have an active R&D tax credit. Anything that's kind of grayed out currently does not have a state R&D tax credit. Again, the federal tax credit is a permanent federal incentive as part of the PATH Act of 2015. The state R&D tax credits are temporary, so some of them do come and go. For example, Oregon's R&D tax credit expired back in 2017, and it has not been renewed. State of Washington does not have any income tax, so there is no state R&D tax credit that would offset that income tax liability. And so again, just as all of these states do differ, they do have their own rules and regulations around the state R&D tax credit, and the percentages that you can get back do vary. So I'm more than happy to take a deep dive into any one of these states just to show you guys, what type of information we do have behind it. Is there a state in particular that we want to look at?
Well, let's just look at California because you used that on the first example.
So California does have a state R&D tax credit, and really, it does follow the regular federal credit method. And in the state of California, you do get back, equal to 15% of the excess of the qualified research expenses over the base amount, which, long story short, just means that you're roughly going to be getting back close to 7.5%. So on the federal side, of the qualifying research expenses that you do identify, you're going to be getting back roughly about 10% on the federal side. So if California is another 7.5%, you're really looking at getting back, close to 17.5% of your qualifying research expenses in a federal and state tax credit. And again, this is a state tax credit that's available to any business of any size, from public C corporations to S corps to partnerships to LLCs, all the way down to the sole proprietors can even qualify on their Schedule C. So again, this is a tax credit that you do claim on your tax returns. And to calculate the tax credits, we need the current year qualifying research expenses and the 4 prior years gross receipts. So again, that is where the tax returns do come into play. And the federal credit actually rolls forward 20 years until you use them. In some cases, if you don't claim the credits, you lose out on the opportunity to use them. However, by claiming them, you at least roll forward the federal credit 20 years, whereas the California R&D tax credit rolls forward indefinitely until you can use them. So that is the one unique fact about the California R&D tax credit is it rolls forward indefinitely. Let's see here. On any of these state pages, we do have the, in this case, the California FTB linked where you can go directly to the state page and learn, about the R&D tax credit, directly from the state. You'll see here that, we do have these available on every state page for you to look a little bit further into. Was there maybe another state that we wanted to look into how it differs?
I'm here in Illinois. Why don't you use Illinois?
Oh. So Illinois, again, it's a temporary tax credit that is available until January 1st, 2027. So through the 2026 tax year. Again, this is a tax credit that could be extended, but currently right now it is good through 2026. This state tax credit is equal to about 6.5 over the comparative base amount, which is closer to about 3 to 4%. So again, getting roughly 10% back on the federal side, whereas you would be looking to get about 3 to 4% back on the state side. Very similar in terms of the eligible entities. Again, you would file these on the Illinois state tax returns for the business, for the partnership, for the S Corp. And this is taking into consideration the prior 3 years qualifying research expenses. It is a comparative tax credit, so it compares the current year to the average 3 years, as does the federal credit. Unlike the California credit, the Illinois credit only carries forward for 5 years. And then again, to learn more about the Illinois State R&D tax credit, you can go to any of these 2 sites. Here is the Illinois General Assembly. It talks about the actual tax code, and then here is the tax form that you would need to claim the credit. Again, there's a lot of good information here on each state. Each state differs, so it is good to really understand first if your state offers a tax credit, and then anticipate what you can give back. I guess just kind of going through the same scenario that we went through earlier. I think I had inputted about $1 million for the brewery and winery here. 750 here, 500 here, and again, we're going to pick the state of Illinois in the brewery and winery space, and you'll see how the credits differ from the California credit. And so, California credit, we were getting roughly back 35,000, and you'll see here that the state is significantly lower, even though we inputted the same numbers. And so again, we can give we can go through the calculator once more on a different industry, and we can kind of start to see how the industries differ as well.
So Tyler, what happens if you have multiple locations and multiple states? How does that work?
No, that's a great question. And so the state R&D tax credit is dependent on where the nature of the work is being performed. So if you are a company in Illinois, but you also have engineers or someone performing R&D in the state of Indiana, you can qualify for the Indiana state R&D tax credits. The catch is you just would have to file an Indiana state tax return. So ultimately it comes down to what states are you filing a tax return in? Is any R&D being performed in those states? And if so, a tax credit can be calculated and claimed on those state tax returns. Again, it's where the nature of the work is being performed is where the state tax credits are going to fall out. So depending on, you could be in any 50 states, you're going to generate a federal credit regardless. Then it's up to, what state is the work being performed? And then are you filing a tax return in that state? And if so, we can absolutely claim it in those states.
So what happens if you don't pay income tax? Then what happens?
So again, if maybe the company is in losses, whether you're on a flow through entity, in that case, you wouldn't be paying taxes in those years. You can still claim the credit. Again, the federal credit would roll forward 20 years until you were profitable and able to use it. The states do vary. But if you're in a state that doesn't offer or doesn't have income tax, like the state of Washington, then again, the credit's not going to be very useful because it wouldn't be offsetting anything. I guess that does bring up a good point. There are a few states out there that, like Texas, doesn't have any income state tax. However, there is a Texas R&D tax credit. However, the Texas R&D tax credit would be offsetting the Texas franchise tax. Or you can use the Texas R&D tax credits to offset sales and use tax. If you're looking to purchase equipment, rent equipment, or lease, a depreciable tangible property. So if you're purchasing equipment that's going to be used during the R&D process, you can use these Texas R&D tax credits to offset the sales tax associated with the purchase or the lease. And so we do assist businesses in Texas. I think Indiana has a similar exemption for property. Again, each state just kind of varies on how you can use the tax credits. For example, Georgia, you can use the Georgia state R&D tax credit to offset payroll liabilities. And so again, each state just kind of differs on how you can use the credits and what you can use them for. For the most part, they offset income tax liabilities, but there are some exceptions. I think another hot topic is the payroll tax credit opportunity. Originally enacted again with the PATH Act of 2015, the provision to the R&D tax credit now allows for qualified small businesses to offset their payroll tax associated with their payroll. And so a qualified small business is any business with less than 5 million in gross receipts or revenues for the calendar year and has 5 or fewer years of gross receipts or revenues, meaning that the company's first year of gross receipts at this point was in 2016 or after. If that was the case and you're under 5 million in the calendar year, you can use your federal R&D tax credits to offset your payroll tax liabilities. So that is the 6.2% of Medicare and Social Security tax that is being paid on behalf of the employer to the IRS. Whether you know it or not, if you have payroll, you're paying that 6.2% of every dollar in. These federal R&D tax credits can offset that, and you can start to get that refunded for the first 5 years of revenues. So we have a number of businesses that are pre-revenue that are taking the credit, offsetting their payroll, getting these refunds even before they have revenues. So again, no company is too small, no company is too large to use the credits. And here's a bit of an example on how the payroll tax credit offset can work. This is an actual use case with one of our clients in the software and hardware industry. Their first year of revenues was 2017. They had about 1.7 million in revenues. So they were under the 5 million threshold. They had less than 5 years of revenues. This company had roughly 15 employees and about a $1 million payroll. So they did have about a $62,000 payroll tax liability, right? That's 6.2% of 1 million is the 62,000. So when going through the R&D tax credit study, we were able to identify about 1.2 million in annual qualifying research expenses. And that came from their payroll, that came from their contractors and their supplies and materials. And so again, you take roughly 10% of that number and you get your federal R&D tax credit amount of about $120,000. And then again, of that $1 million payroll, you have that 6.2% is your payroll tax liability paid to the IRS. So $62,000 per year. You pay those in on the quarterly form 941s, so the payroll reports. And if you take that 62,000 divided by four quarters, you get roughly 15,500 of payroll tax liabilities that the business is paying into the IRS every quarter. this 15,500 is the amount that the business would start to get refunded. So if you just took the 120,000 of federal credits by that, 15,500, you get roughly, 23 months of free payroll or eliminated payroll. And that is certainly significant for any startup, as cash is king. By being able to put, essentially, 23 months of free payroll back in the company's pocket. This does extend their runway. It does allow them to grow. And that's what the tax credit is meant to be. Are there any questions about how the payroll tax credit opportunity works?
So Tyler, you have covered a lot of information, and I know that you're available to meet with people one-on-one. And again, it's just to sit down and continue these discussions or look at what their companies may or may not need. So we can get your calendar. Can we get that in the chat for people so that they can at least know how to get a hold of you?
Yeah, Stephen, would you mind dropping maybe my calendar?
All set. Yep. Good to
I
go.
appreciate you bringing that up, Francesco. And so again, with this payroll tax credit opportunity, with our business model, with our success-based fee structure, we do see a lot of payroll opportunities taking advantage of this tax credit for the first time, whereas they may have never taken advantage of the credit. Just because there is no out-of-pocket expenses. They truly benefit first before we get paid, and it's something that we do believe that we're aligning our interests with our clients from day one. And it's exciting to see businesses taking the credit that are ultimately entitled to the credit. If you're looking to partner, with the Strike team, we do have this partner page here where we are able to offer, a revenue share, a finder's fee for the introduction. Again, we're just looking to optimize the value for your clients. We work with a number of partners, including B2B CFO and Francesca and her team. And we work with a number of CPA firms, outsourced CFO firms, family offices, VC firms, private equity firms, really anyone that's has that center of influence over their client, we're looking to partner with and add this value-added service. Again, you can kind of come in here and we'll be able to get in contact with you. We can book a meeting here directly. We also have a number of industries that we do specialize in, from aerospace and defense to the alcoholic beverages, as Francesca had mentioned. Engineering and architecture firms are an industry that is highly qualified. We do work with a number of engineering and architect firms and are able to maximize their credits. Food and beverage, the industrial hemp and CBD industries are now considered a federally legal business as of the 2018 Farm Bill. So starting with the 2019 tax year, these hemp and CBD businesses are able to take the federal and state tax credits. And it's an exciting opportunity in a fast-growing new industry. There's a ton of R&D being performed. We do have specialty in these industries as well. Manufacturing is typically the industry that has claimed the tax credit the most, as per the IRS, since the tax credit was initiated back in 1981. The medical and pharmaceutical biotech industries are your typical white lab coat and test tube. Those are the folks that you think of when you think of research and development. Again, highly qualified industry for us. The software and technology industries are an industry that has gained support from the R&D tax credit over the years as the industries kind of have matured. And so we see the software and technology space actually being a highly qualified with expenses averaging up to 55% of the expenses being qualified. So we could take a look at the software and technology industry. Like I had mentioned, roughly 55% or on average, total software development expenses typically qualify. And this is higher than most other industries. Like I had mentioned, and And the type of activities that do qualify is anywhere from a mobile application development, a mobile app. If you're developing a software as a service or a SaaS platform, just developing source code, testing source code. If you're using machine learning or artificial intelligence, you're likely doing something that nobody's ever done before. And again, it doesn't have to be new to the whole world. It just needs to be new to the business. The first time the business has undergone these activities and expenses. You could be integrating third-party software or doing some custom integrations. Can also qualify. You could be, again, doing the system architecture or cloud-based integrations. You could be doing the UI, UX user interfaces. You could be doing prototyping. All of this qualifies. And again, we're really looking at these job titles. Again, it is a technical tax credit. And so we're really looking at the day-to-day activities and the expenses that are associated. It really first starts at looking at the job titles, gives us a good idea of who's doing the technical work. So in this case, we're looking at, developers, could be a C-suite, someone supervising the work, could be a data scientist, software developer, software engineer, research analysis, QA, QC, anyone that's involved in the software development lifecycle process can qualify. Could be a project manager. And so first starts by always looking at the type of job descriptions and job titles to really determine, at a high glance, who's doing the qualifying work.
So Tyler, what if you're hiring people offshore to do development work or whatever? How does that work then? Or it's not in your state?
Yep. So that's a good question. And exactly. So the U.S. R&D tax credit is meant to keep these businesses here, these jobs here in the U.S. And so unfortunately, if you're outsourcing for cheaper labor overseas, those are expenses that cannot be picked up for the R&D tax credit here. There are other countries that have their own version of the R&D tax credit where, if you have a subsidiary over there, you might be able to take advantage. But, if the technical work is being done overseas, that expenses cannot qualify. However, if you do have folks here in the U.S. that are supervising or supporting the development happening overseas, we can pick up maybe a percentage of that team or that team member's time that is supervising the work being done overseas or supporting the work being done overseas. So just because the work's being done overseas doesn't mean we can't pick up anything. Again, supervisory and supporting activities do qualify as well. And I am just going to use some of the numbers that we have been using throughout this presentation, and I am going to show how the software industry is a higher qualified industry than the brewery and winery industry. So again, we were seeing about 35,000 in California with these same numbers for the brewery. Again, that number almost triples up to about 105,000. And so you can see that the software and technology industry is much highly qualified than the brewery and winery space. And so that is just an example of how the different industries here can generate different size of tax credits. Is there any questions here? Or how about another industry that we want to look into?
Try construction, just because of the mishap in Florida this morning that's all over the news.
Okay. Yep. And so you can, again, on the software and technology industry page, you can look at, blockchain specifically. We have a whole sub-industry page on just blockchain. Maybe you want to look at the cryptocurrency or the fintech. We also do have these sub-industry pages here where you can take a deeper dive. So construction, I guess it could fall under architecture and engineering. We have construction engineering here. Whereas construction itself, may not be qualified, but when you're really looking at construction, it has to do with architecture and engineering. So we have construction and engineering here as being qualified. The construction of buildings, housing, civil works, utilities, highways, sewers, water supply systems can be qualified, such as developing new or improved methods in construction processes. Maybe you're creating new technology or software to aid in your construction process. maybe you're evaluating new raw materials to develop a new type of material that may be best fit for the project. Maybe you're just implementing novel robotics or automation methods within the process. Improving a process can be qualified as well. Maybe you're just assessing the optimal use of certain materials or equipment or labor to maximize your project efficiencies. Those types of activities can be considered qualified. Just developing novel approaches to improve the construction worker health and safety could also be considered qualified if it's technical in nature. So again, we're looking at those job titles, really those engineer folks that are performing the research. The way we look at it is once the blueprint has been set, for the most part, the R&D has been finished up until the point you need to redesign, re-engineer some of the processes or products or buildings themselves. Does that make sense? Whereas like your typical, folks on the construction site that are just building the building itself is not considered a qualifying activity. It does have to do with like improving that process or looking at novel methods to just improve the equipment, the materials themselves. Does that kind of answer some of your questions, Francesca?
It does. Do you want to just run those numbers through your calculator and see what that looks like?
Yeah. We'll use California again. And then again, you'd want to be using, you can call it the engineering, or we can do general contractor here. We'll do the general contractor for now. And again, this is a highly qualified industry if you are a general contractor where you are being contracted to just do the construction engineering. You would see, if we were to pick just the engineering, I would anticipate these numbers to drop just a little bit. Let's go ahead and do those. There you go. The engineering firm. There's a lot of engineering firms that will do the engineering, the high-end design and engineering, but they'll also do the construction management side of that, whereas the construction management side does not necessarily qualify again. So it is everything up until the point where the blueprints are created, you've done the R&D, you've figured out the optimal process and methods to develop. Now it's time to go build. So we do see the engineering industry, I think average qualifying research expenses are between 25 and 33%.
Tyler, that calculator is such a valuable tool to be able to for budgeting purposes or to, forward looking. It's really great.
Yep. We, these numbers are rather accurate. If you're going to be entering the accurate gross payroll, contractor supplies, materials, these are industry averages, so they're not perfect. Each company, each study is very different. Again, we need to take a hands-on approach to really understand, the business's day-to-day activities. What are the employees doing? What are the qualifying projects? Are you developing IP or R&D internally, or are you doing it for others? These are all things that we must take into consideration when performing the R&D study. And so, one engineering firm's credits could be a lot different than the other, just depending on the nature of their contracts, their rights and their risks that they take on. So these are all stuff that, our team of CPAs, enrolled agents, attorneys, and engineers all look at. We've got about 8 to 10 minutes here. Is there any other questions? Maybe we can kind of open it up for questions here now. Here's just our fact page. We can always learn about, if you have some questions, maybe the answers are here. Do we have any other questions? Comments?
So if we don't have any other questions, Ken, do you have the testimonial type questions? If you have any comments for us, or if this information was helpful and useful for you, if you could just throw that into the chat, just so that we're just trying to get this information out to people so that they can use this and have it, know that this is available out there to take the funds that are available. So whatever your biggest aha moment or takeaway that maybe you'll implement from this, or what did you like best about the summer? We'd love your feedback. Somebody else had asked if we were going to be posting a recording, and I think that we are working on that for this recording. And Tyler's calendar is back in the chat, as well as the website information. And again, working with Tyler and walking through this process, or how this might be helpful for your organization. I know we have one person on the call who does taxes, who does about 400 of them. Tyler is a great resource for you, for your business.
We're always here to answer questions. Just talk through the tax credit, how it might be applicable to your client, your firm. And yeah, we see it as a tax credit that every business should be entitled to taking, which is why we created the model that we have. Again, there's no out-of-pocket cost for your client to get started, or you, the business owner. And we go through the process. If we don't find any tax credits, you don't owe us anything. But yeah, no, I appreciate everybody joining and the questions that were asked. And we definitely look forward to working with or speaking to each and every one of you. There's a lot of valuable information here on the site that we didn't get through, so feel free to see to go to striketax.com and let us know if you have any questions.
Nice. Thank you, Tyler.
Thank you, guys.
Great job with all the information. I know it's a lot to get through. So Carol has a question on help for startups.
Yes.
You want to cover that, Tyler?
Yeah, I don't know if I saw the question.
She just asked if there's any help for startups.
So for startups, yes, the startups typically mean the business may not be profitable. They're in their early years. They can still qualify for this payroll tax credit offset. So, really the benefits start to kick in once you do have payroll, someone that's on a W-2 employee, whereas the business itself is paying that 6.2% of the payroll tax liabilities to the IRS. This is an amount that you can start to get refunded, or at least offset in real time. They get credited. So again, payroll, we work with a number of businesses that are pre-revenue and they're building their software, their technology, or their product, and they're performing a lot of R&D to get that product live. Really, we see it as up until the point where you launch commercially a product, your technology, your software, that all those activities and expenses associated for the most part can be considered qualified. So, we help with the number of, again, like I mentioned, pre-revenue companies that are looking to launch their product and just go live. And so they're able to use these tax credits to start offsetting that payroll tax liability and start getting that refunded to them. If they don't have payroll, maybe they have 1099s, they can still generate the tax credits. They just wouldn't be able to use the tax credits until they had payroll or they were they're profitable from a tax position.
So I have two companies right now that I'm working with, both of them being startups. So they would qualify for this. There's somebody else on the call who has a passion for networking, and she may be starting something soon. And if that happens, we're certainly going to look at this R&D tax credit as to how we can best leverage this as part of her startup costs with what she's doing.
Awesome. Yep. And I always say there's two best times to take advantage of these tax credits. It is in year one when you're first starting those first expenses that you can put in these processes and protocols to understand, what are R&D tax credit eligible, what can you start to get back or anticipate. And then the next best time is when you're turning that corner to profitability, when you're going to really be able to use these credits to maximize that potential.
Well, and also having the knowledge too, Tyler, that you've got the state tax laws out there. So that may help you plan that we need to move faster on something because it expires.
Right.
All right. I think if we have nothing else, Tyler, thank you so much. Very, very informative. I appreciate all your time with doing this. I know it's a lot to get through. It's a lot of information, but and I tell you, we've been doing this since January, and every time we do this, I learn something new. So there's just a lot to absorb with this.
Absolutely.
All right. Thank you everyone for coming. We appreciate your time, and please feel free to reach out to us if you need assistance.
Thank you guys.
Thank